Imagine this. The Philippines, once called the sick man of Asia, is now one of the fastest-growing economies in Southeast Asia. The nation is buzzing with opportunities. Foreign investments are pouring in, infrastructure is booming, and the digital revolution is reshaping industries. But here's the real question. Can the Philippines sustain this momentum and surpass its neighbors like Thailand, Vietnam, and Indonesia? To answer this, we need to look at historical trends, current economic data, and future projections. The Philippines has the potential to become a leading economic force in the region, but challenges remain. So, let's break it down step by step. 1. The rise of the Philippine economy. How did we get here? Not too long ago, the Philippines struggled with political instability, corruption, and slow economic growth. While neighboring countries like Malaysia and Thailand developed strong industrial bases, the Philippines lagged due to mismanagement and weak infrastructure. But over the past 2 decades, a series of reforms transformed the country. Economic liberalization opened doors for foreign investment. The IT/BPO, business process outsourcing industry boomed, making the Philippines a global outsourcing hub. Overseas Filipino workers, OFWs, contributed billions through remittances, stabilizing the economy. Government-backed infrastructure projects created more jobs and improved connectivity. These changes accelerated GDP growth, positioning the Philippines as a rising star in ASEAN. 2. Key economic indicators. Where does the Philippines stand today? Let's look at real data to understand the Philippines' current economic standing. GDP growth. In 2024, the Philippines recorded 5.6% GDP growth, making it one of the fastest-growing economies in Asia. pna.gov.ph. Foreign direct investment, were FDI. Investment inflows have increased, especially in manufacturing, real estate, and digital startups. Per capita income. As of 2024, the Philippines' GDP per capita stands at $4,170, behind Malaysia and Thailand, but improving steadily. Philstar.com. Infrastructure development. The government's Build, Build, Build program has significantly upgraded roads, airports, and public transport. However, the Philippines still lags behind ASEAN neighbors in transport efficiency. 3. Can the Philippines surpass its ASEAN neighbors? A comparative analysis. To determine whether the Philippines can outgrow Thailand, Vietnam, and Indonesia, we need a head-to-head comparison. Vietnam achieves 6% plus GDP growth consistently. Strong manufacturing hub with global exports. Attracts high-tech investments, e.g. Samsung and Intel. Indonesia, the largest ASEAN economy with a huge domestic market. Rich in natural resources, coal, palm oil, and nickel. GDP growth around 5% annually. Thailand and Malaysia. Both are more industrialized with higher per capita incomes. Facing economic slowdowns due to an aging population and stagnant growth. The Philippines has the advantage of a young English-speaking workforce, making it a top choice for outsourcing and digital innovation. However, to surpass its neighbors, it must solve key issues like infrastructure gaps, bureaucratic inefficiencies, and dependency on remittances. The challenges holding the Philippines back. Despite its rapid growth, several obstacles could prevent the Philippines from overtaking its ASEAN neighbors. 1. Weak infrastructure. Compared to Thailand and Vietnam, the Philippines needs better roads, railways, and ports to improve logistics and trade. 2. Political uncertainty. Investors need consistent policies and a stable political climate for long-term growth. 3. Education system. Needs upgrading. The workforce is young but lacks specialized skills in high-tech industries. 4. Over-reliance on remittances. While OFW remittances help stabilize the economy, they do not create long-term wealth or industries. The roadmap to becoming an ASEAN leader. How can the Philippines overtake its neighbors in the next decade? Here's the winning strategy. Massive infrastructure investment. Build more smart cities, efficient transport systems, and digital highways. Strengthen industrial growth. Reduce reliance on imports and expand local manufacturing. Enhance digital economy. Invest in AI, blockchain, and fintech to attract high-value investments. Improve education and workforce skills. Focus on STEM, entrepreneurship, and tech innovation. Attract more foreign investors. Implement pro-business policies and improve ease of doing business. Sustain political stability. Ensure consistent economic policies regardless of leadership changes. Services and industry. These sectors were pivotal in driving economic growth. The services sector expanded by 6.7%, while the industry sector grew by 5.6%. Notably, wholesale and retail trade increased by 5.6%, contributing 1.1 percentage points to GDP growth. Financial and insurance activities surged by 9.0%, adding 0.8 percentage points, and professional and business services grew by 7.9%, contributing 0.5 percentage points. The construction industry also exhibited robust growth, with a 10.3% increase, reflecting heightened infrastructure development and investment activities. Department of Finance Agriculture. In contrast, the agriculture sector faced significant setbacks, contracting by 1.6% due to a series of 6 successive typhoons that disrupted crop production, livestock, and fisheries. This decline highlights the sector's vulnerability to climatic events and underscores the need for enhanced resilience measures. Department of Finance labor market and income levels. The labor market showed commendable strength, with the unemployment rate dropping to 4.0%, surpassing the full-year target range of 4.4% to 4.7%. This improvement translated to 48.6 million Filipinos employed from January to October 2024, with wage and salary workers comprising 63.8% of the employed population, indicating a stable and formal job market. Additionally, the Philippines achieved an all-time high gross national income, GNI, per capita of 4,335 United States dollars, 241,165 Philippine pesos, in 2023, reflecting enhanced economic prosperity and improved living standards. This milestone positions the country on the cusp of attaining upper middle-income status, as defined by the World Bank's threshold of 4,516 to 14,005 for 2025. Department of Finance Inflation and Monetary Policy. Inflation remained within manageable levels, averaging 3.2% year-to-date, aligning with the Development Budget Coordination Committee's DBCC assumption of 3.1% to 3.3%. This stability was partly due to effective government interventions, such as Executive Order No. 62, implemented in July 2024, which reduced import tariffs on rice, leading to a decline in rice inflation from 22.5% in June to 5.1% in November. The Bangko Sentral ng Pilipinas, BSP, responded to the favorable inflation outlook by initiating monetary policy easing. In August, the BSP reduced the key policy rate by 25 basis points, followed by another 25 basis points, cut in October, bringing the benchmark rate to 6.0%. Additionally, the reserve requirements for financial intermediaries were lowered by 250 basis points to stimulate economic activity. Trade and external sector. The trade sector experienced mixed outcomes. Imports rose by 9.9% year-on-year in September, indicating robust domestic consumption. However, exports declined by 7.6% during the same period, reflecting subdued global demand and ongoing trade challenges. Reuters, stock market, and foreign investment. In early 2025, Southeast Asian stock markets, including the Philippines, faced significant foreign investment outflows, totaling $4.16 billion, the largest since 2020. Factors contributing to this trend included concerns over economic growth, domestic issues, and U.S. tariff policies. Notably, while analysts initially anticipated that U.S. tariffs on China might benefit Southeast Asian markets, reciprocal tariffs have also impacted the region, leading investors to seek opportunities in Chinese equities, which offered more attractive valuations. Economic outlook for 2025. Looking ahead, the Philippine government has set a GDP growth target range of 6.0% to 6.5% for 2025, adjusting from the previous upper limit of 7% due to prevailing domestic and global uncertainties. Finance Secretary Ralph Recto expressed confidence in achieving at least a 6.0% growth rate, emphasizing the administration's commitment to sustaining economic momentum. The economic outlook remains bullish, driven by expectations of lower inflation, increased consumption, and heightened investments. The implementation of the corporate recovery and tax incentives for enterprises to maximize opportunities for reinvigorating the economy, create more. ACT is anticipated to enhance the Philippines' attractiveness as an investment destination, fostering economic growth and job creation.